So how do you win in a high interest rate environment? Right now, we are in a high interest rate environment. It wasn't too long ago that the Fed came on and vowed to slay the dragon called inflation, which was running rampant upward around 8+%. How did they slay that dragon? They increased interest rates very quickly. And that caused a lot of pain for a lot of folks. It caused pain for people that use credit cards because their credit cards rate went up. It caused pain for people that needed to buy a car or a boat or anything because that rate went up. And it caused a lot of pain in the housing market because interest rates, which were around 3% for a 30-year mortgage, are now 8%. So, how do you win in that environment where everybody else is losing? It's easy. What you need to do is you need to look at where big money goes. You got to look at where the opportunity is in a high interest rate environment. So many people love to focus on the negatives of high interest rates. I like to focus on the positive of a high interest rate environment. I mean, make no two ways about it. Your savings account is probably paying you more now than it was before. You can get CDs for a higher rate than you were before. You can definitely find yourself a high yielding savings account, upward around 4+%. So those are all positives, right? But some of you would say, yeah, but I get paid more on my savings, but it costs me more to buy groceries. I get paid more on my savings, but my car payments are higher. I get paid more on my savings, but my mortgage payment's higher than it was before. And you're right, it's a balancing act, but you can beat that. And the way to beat it is simple. You need to understand what happens when interest rates go up and where your money needs to go, but you also need to understand a simple concept that I've been teaching for almost a decade now called the infinite banking concepts. Because the infinite banking concepts allows you to take back the banking functions in your life. So in other words, if your car payment is at a 7% interest rate, wouldn't that be cool if you were making a 7% car payment to yourself? Well, that would be better than making a 3% car payment to yourself. Now let's go one more round. If you're paying 20% to the credit card companies, wouldn't it be cool if you were paying 20% back to your banking system? If every month you wrote the same check you write to credit cards, but you paid yourself back. It would be cool, right? So then you'd be like,
I want rates to stay higher for longer. Well,
that's good. So because Jerome said higher rates for longer, that means more money for you.
More money for you. Like and subscribe. Hit the bell.
Hey, if you didn't catch that, click the subscribe button and smash that little bell that James just smashed. So let's dive in and let me just break this down for you how high interest rates are actually a good thing for you making money. So I want you to win in this high interest rate environment. I want you to win in the same way that giant mutually owned insurance companies are winning. So it just so happens that I get to go on conferences every single year with a couple different big giant mutually owned insurance companies. And when I'm out there, I get to talk to the CFO, I get to talk to the investment teams, and I get to spend some time and talk with the president and CEO of these companies. And being that I'm infatuated with the economics and how all this works, I always ask the CEO, hey, what are you guys doing with your safe money? With a giant mutually owned insurance company, almost all their money is safe money. And it was an interesting conversation because I was just in California and then I was in Bahamas, and both insurance companies' CEOs said almost the exact same thing. They love it. They love higher interest rates because it allows them to position their portfolio in safe money and get paid for the risk. So what am I referring to? Well, insurance companies, make no two ways about it, buy bonds. What kind of bonds do they buy? Well, they love treasury bonds issued by the United States of America. Why? Because they are one of the safest places they can put their money. Not only are treasury bonds guaranteed by the full faith and credit of the United States government, not only has the United States never defaulted on any of their debts, but they are highly liquid. So if the insurance company needed to liquidate something to create some capital, treasury bonds are very liquid. But here's the real reason, because all that's just fluff. Here's the real reason insurance companies love buying treasury bonds right now. Number one, in a high interest rate environment, they get paid. They get paid a higher interest rate. A long-term treasury, like a 10-year or a 30-year treasury bond, can pay them between 4 and over 5%. But you see, right now, because we're in an inverted yield curve, which I'm not going to get into in this discussion, and they can gobble up short-term treasuries. They can buy T-bills, 2 months, they can buy 6 months, they can buy 2-year treasuries, short-term, and get paid over 5% by today's numbers, which we are in 2024 right now. That is unheard of. That has not happened in probably the last decade or a little bit longer. So insurance companies are thrilled to earn over 5% on their safe money by buying bonds from the United States government. But here is the silver lining that you might not know. When the Fed increases interest rates very quickly, like they just did to combat inflation, what you might not know is that bond prices on those longer duration bonds comes down very quickly. Think of it like an X, okay? When interest rates go up, so this one right here with the watch, that's interest rates. When rates go up, price of bonds goes down. It's an inverse relationship. So if rates go up, the price of bonds goes down, but the yield is higher. So think about that. The insurance companies are able to buy these bonds at a discount and still get paid a high yield. But they also know the flip side of that. Let's just do it this way. Okay, I can't really do the X any other way. Let's do it this way. Now, in the future, insurance companies and these CEOs know that things are going to get a little bit difficult in the economy. And when they do, if we enter a recession or we get into slower economic times, the insurance company knows, and anyone that understands treasuries knows, that when rates go down, which the Fed has already hinted that they plan to drop rates. They plan to lower rates. We thought it was going to happen this year. It may or may not, but they will go down. So when rates go down, the price of the bonds go up. So now the insurance company is getting paid a really good yield, a good interest rate on their money. And they know that they bought those bonds at a low price. And they know that in the future, the price will be higher because of interest rates. Think about that. Is that not cool? Like, you can get paid for taking less risk and have full liquidity of your money because of the liquidity feature of how bonds work. You can just get your money back. So if insurance companies are gobbling up these bonds, which is helping their profitability, because their profitability is based on not only their sales and their business, but also the performance of their assets, because insurance companies have more cash sitting around than just about any other financial institution out there. Way, 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 way more than banks, way more than these Wall Street firms. Why? Because insurance companies have made promises way out into the future that they need to be able to fulfill on. So it is mandated that they have assets to cover those liabilities, where banks, traditional banks, are only required to keep just about 10% of Tier 1 capital set aside. So for every dollar you put into a bank, that bank is only required to keep 10 cents, give or take a fraction of a penny or two. They're 10 cents for your dollar. How's that make you feel? You're probably like, well, I don't feel bad about it, because then there's that FDIC thing. You need to do some research on how much money FDIC has, because the FDIC can't fulfill on their promises of making sure that every depositor up to $250,000 is protected, unless the Fed printed more money. But let's go over to the insurance companies. You see, they don't play that game. They don't play that game at all. If they promise somebody a dollar, they got to have a dollar. So if they promise they'll pay out a death benefit the day you die for a dollar, they need to have a dollar in reserves, a dollar in their assets. So where do those assets get invested? Bonds, heavily treasury bonds, AAA rated corporate bonds, safe bonds. And safe money today, more than anywhere in the last decade or longer, is getting paid good. So because insurance companies are more profitable, that leads me to the next place where you could look to benefit from higher interest rates. So insurance companies, primarily mutually owned insurance companies, benefit from higher interest rate environments. And because they benefit from that, that means they profit from that. I saw the numbers, which I can't disclose here on this thing, but profits are up largely because of the portfolio performance of these insurance companies. And if you were a stockholder in a company and their performance went up because their portfolio returns went up, you would benefit in the form of either your stock price going up or dividends on those stocks, right? But you see, we're talking about giant mutually owned. Mutually means no stockholders. But who are the owners? Technically, policyholders are the owners in a mutually owned insurance company. So because insurance companies are more profitable, that leads me to the next place where you could look to benefit from higher interest rates. So insurance companies, primarily mutually owned insurance companies, benefit from higher interest rate environments. And because they benefit from that, that means they profit from that. I saw the numbers, which I can't disclose here on this thing, but profits are up, largely because of the portfolio performance of these insurance companies. And if you were a stockholder in a company and their performance went up because their portfolio returns went up, you would benefit in the form of either your stock price going up or dividends on those stocks, right? But you see, we're talking about giant mutually owned. Mutually means no stockholders. But who are the owners? Technically, policyholders are the owners in a mutually owned insurance company. So if you were to become a policyholder of one of these specially designed and engineered whole life insurance policies, well, I'll just go back the last 2 years. But what has happened if you're a policyholder over the last couple of years is you have seen your dividends go up. Why have your dividends gone up? Because the insurance company's portfolios are more profitable, and more profit means slightly better dividend performance. So if we stay in these higher interest rate environments for longer, insurance companies will benefit from the tailwind behind their bond portfolios. And therefore, I can't promise, but we've seen the last couple of years, and I think we'll probably see it a little bit into the future. No guarantees. Past performance is not a representation of future outcomes, but you might see dividends continue to go up like we have in prior periods of time. So, what would be a good place to put safe money to benefit from high interest rates? Well, I already said it. Treasury bonds, T-bills, and specially designed and engineered participating whole life. What do I mean by participating? The insurance company participates, meaning they pay dividends. So you do that, you're benefiting. But now you've kept and maintained liquidity on both sides. Liquidity and control of your money is so vital. So inside the policy, you have control of your money. You can take your money out in the form of loans. You can even take your money out in withdrawals. It's not what we teach, but you can. And treasuries, you can just sell them in the open market. So those are two really good places to put your money. But let's go one step further. How else can you benefit from high interest rate environments like this? Well, I don't ever like to talk about this, but you could ladder CDs. I know when I was a financial advisor years ago, we hated CDs, and I still don't like them because they're a probatable asset. You lock your money up for a period of time, and if you need the money back, the bank takes some of that interest that they paid you back. So there's a lot of reasons I don't like CDs, but CDs right now are paying a pretty good interest rate. So you can't ignore that. Let's say you got some money that's sitting aside that's for something in a year from now. You plan on next year doing a remodel on your house, but you're not gonna need this money until then. Great, go out and buy yourself a 6-month CD, and then in 6 months, the money has grown with a better interest rate than you could have gotten in a regular checking or savings account. That's not a bad place to put some safe money. So bringing all this back to how do you win in a high interest rate environment, that's the two things I will tell you. I even mentioned CDs, but those two, participating whole life insurance policies, and I would suggest that you design and engineer that with someone like our team so that it is designed for high early cash value, and treasury bonds and T-bills. Those are really great places right now to capture and benefit from higher interest rates. But here's the thing. I hear it all the time, mostly from people from Buffalo, but I already said that. They always want to compare the whole life and the whole life's returns, that 3 to 5%, they want to compare that to, I can make more money in stocks. And I always answer that the same way. You see, I read a book that my friend Caleb came up with, and it's called The And Asset. And that book was so precise about explaining this. It said, it is not the whole life policy or a stock portfolio. It is not a whole life policy or real estate. It is not a whole life policy or a private loan. It is not a whole life insurance policy or anything. It is the whole life insurance policy and the stock account, the whole life policy and real estate, the whole life policy and private lending, the whole life policy and the other investment, and not or. Because everything we teach involves changing one thing, and that is where your hard-earned savings goes first. Not where it goes first and stays. It's just where it goes first. And then we're gonna take the money from the policy immediately in the first 30 days, and we're gonna deploy it somewhere into an investment, into paying off debt, into buying our cars or paying our cars off, somewhere where it can earn a higher interest rate than what the insurance company charges us to borrow that money, which right now is about 4.8 to 5.25%. So if we can make this money go work higher than that, and all the people from Buffalo will tell you, oh, stocks are way higher than that. Great. Let's just say you're gonna make 8% on your stock portfolio. I'm gonna put the money in the whole life. I'm gonna make my 3 to 5%. I'm gonna take a loan from the whole life policy that's gonna cost me, let's just call it 5%, and I'm gonna invest it in stocks making 8. How much money did I just make, and how many times did I make money? You see, I saved my safe money in the whole life, and I took the money out and I bought stocks. So now I have the whole life and the returns I get with the whole life, because remember, the whole life pays you uninterrupted compounding interest on your cash value growth, even when you take the loan. Because when you take the loan, as long as the company's non-direct recognition, the money you took out is not recognized by the insurance company. The loan is not recognized. Therefore, your money's all in the cash value earning interest, uninterrupted, and your money is now in stocks earning interest or compounding or however it's growing, because stocks can grow lots of different ways, capital gains, dividends. It's growing over here. So now I'm making money twice on the same dollar, but it even gets better. Remember, the policy is growing uninterrupted compounding interest, okay? Therefore, next year, the spread I make on the policy is higher. And the next year, it's higher. And the next year, it's higher. It's just basic mathematics. Now, the stock portfolio might go up, it might go down, it might stay the same, but at least I have the stock portfolio because I said, oh, stocks are better than the whole life. Stocks make more than whole life. It doesn't matter. It's the whole life and the stocks, the combination of the two. Folks, I hope that helps you. If you enjoyed this video, you're gonna wanna check this one out right here. IBC without whole life insurance. We'll see you on the next episode.